The Hedgeless Horseman here. It's December the 5th, 2025. First of all, thanks to the sponsors. Let's look at the markets. Silver is almost at 59. Gold went up to, I don't know, 42.80 or something, down a bit. Crypto, okay, getting kicked in the teeth a bit. Market steady. Yeah, so I mean, one thing that I guess many people have noticed, I mean, just how volatile silver has been lately. If we go into the hourly chart, okay, I thought it would be looking even worse. Okay, let's do 5 minutes. I mean, it's like, up and down. It's like down to 56, up to 59.6, up to 59.9. So, I mean, obviously it looks like, whatever. There's some, let's say, resistance here. But the main point, again, is like, I mean, how are you, I mean, this picture says a lot, I think. I mean, why I don't short-term trade. I mean, take this spot here, for example. It's like, I mean, I know this is a short-term graph, etc. But it's like, and there's different versions of trading and stuff. But it's like, okay, well, this looks like a breakout. So let's say I go along, and it's like, joop, this happens, and then it's like, oh, now it's broken. Back, it's a it's a, what do you call it, fake breakout. It's like, okay, let's go short because you think it's gonna go down even lower. Obviously, I'm not describing anything in terms of actual trading technicals. I'm just making up stuff now. I guess that's confirmation bias, but yeah, it's just pure chaos. It's like, okay, drops like a stone, then goes back, breaks above this level again, almost up to the same spot here. Then it turns down, and then it's like chuk, 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 chuk. Here you could draw a line here, let's say, and it's like goes up. It's basically, if I can't come up with a worse occupation than being a short-term silver trader. I guess there's like one in a million who actually, I don't know, can make sense out of this and have pivot points or whatever. But it's like, I don't see any. Where's the real risk reward? I just don't see it. So that's why I just keep tweeting or posting. It's like every day is noise. Basically, I have no idea where silver is gonna close today. I don't know where it's gonna close tomorrow or next week or anything like that. I just try to pick the low-hanging fruit, buy companies that are cheap as chips, and in case of silver, that preferably are cheap, even if silver went to $30, for example, or should do okay. And if they can increase the value, etc., etc., you can get bailed out, even if silver goes down, but you're right on the fundamentals, etc. Yeah, so it's like I don't pay much attention to the mel prices because I know how it feels. I mean, if mels are down, it feels like, okay, we started a correction. If they're up, I'm thinking like most of us feel that, oh, here we go. I mean, take this for example. I mean, broke out of these two tops here, and then it reversed again. It's basically, yeah, I don't know. I can't make much sense out of this, so I don't even try. I don't, why play the game that is extremely hard to beat? Not for me, thanks. I prefer, a more longer-term hodl approach. Let's look at some news. I mean, the title of this, or the theme of this video, I guess, is gonna be, we're in a bull market. I think one could argue that. and taking some big picture views basically, and why I'm very comfortable just keep hodling basically, because in my, I mean, if I had to guess, I think we might have a few years worth of good, increasing sentiment, probably increasing metal prices over the next maybe few to several years. So I want to make sure to capture that. The as always, I mean, the big money is in the big moves. The big money is not in the short-term noise. But here's I just threw this in here. U.S. plans more stakes in mineral companies, Trump official says. I mean, obviously, we've seen, MP Materials and some tungsten plays, for example, get lit on fire. And many and people just seeing that obviously are going to be out, trying to hunt which is the company that might get a stake from the U.S. government, and maybe have that as their flagship case for a junior, that or minor, whatever it might be. That I'm going to buy this company because I think the U.S. government might invest, and that might light it on fire. Of course, you can make a case out of that, but to me, it's still not enough of an edge. Let's say, if it's cheap, I mean, or my argument being that I don't want really, or typically at least, I mean, there might be exceptions, but I want something that's cheap based on fundamentals. It's like I'm not too interested in looking for the greater fool trading sardine or greater fool theory to make money, where it's like, oh, I don't care really how expensive or cheap it is. I think that if the U.S. government is going to invest, it's going to get lit on fire. Would it be nice to have that in the back pocket? Of course. It's like Stillwater, for example, their big polymetallic project in Montana. That's obviously, or I think, I mean, they have, I don't know, 6, 7 minerals that are on the U.S. critical minerals list. So do I think there's, optionality that, hey, the project is good, but it could get an extra boost from the fact that, the political tailwinds in the U.S. right now and what their project is? Yes, but I wouldn't own Stillwater just because I'm betting on the U.S. government, bailing me out. So what I'm trying to say, I guess, is like it's interesting, and I see some stocks pop on this, and I've seen some who are actively hunting, but then I come back to how much conviction can I get up to? I mean, let's say I find one where it's like, oh, I think the government is gonna take us a piece here. I mean, if it's cheap, then it doesn't really matter. But how much of an edge or how much of an opportunity for the entire portfolio am I gonna find? I mean, let's say I research and finds one that's like how decently cheap, and then I think, oh, they have a high likelihood of getting a boost from the U.S. government, and maybe all hell breaks loose. But like, how much would I be willing to have in terms of position size, mostly because of that fact, or not that fact, but that thesis? I mean, maybe not too much. Let's say you have take a 2% position, and it's like, okay, well, it's great if it happens, but it's still not really gonna make the portfolio. Let's say you get a 100% return on the back of some U.S. government involvement. Well, I mean, the portfolio would earn 2%, so it's absolutely nothing to sneeze at for sure. But still, it's I don't know. To me, it's simply not worth the hunting. Again, I'm not saying that that's the best way to go about it. I guess I'm trying to relay, how I sometimes look at things where I want to keep it simple. I want no brainers, and I even if there is a good case for some external shock, um, usually I probably wouldn't be comfortable enough to take a big stake. So it's like, okay, do I rather buy something I think is really cheap, but I don't see the U.S. government getting involved, or would I, rather buy something where I don't think it's that cheap, but I think the U.S. government can get involved. I mean, as a value investor, I guess, typically you don't, hang up a case on third party interference from a government like that. Anyway, yeah. So I mean, let's go through some tweets that I think are actually relevant. If you want to waste a bull market, it's good to start with trying to make perfect buys and sells in the short term. Uh, just going back to silver again, it's like if I have a feeling that here it's gonna go up, and I whatever increased my silver exposure on this breakout or perceived breakout, then it reverses, and then I think, oh, now it's going to go lower, then I sell it. So I would probably be cut to pieces if I tried to, at least without, since I am not a veteran day trader or anything like that. No, I still see the best obvious case is that buy stuff that's cheap. It's going to go up on average sooner or later. So it's more important for me to find companies that I think are cheap and can go up a lot over the coming years. And if that happens to coincide with a few to multi-year, several year bull market, you're gonna make a lot of money. Even if you don't have a, very concentrated portfolio. Because I think there's so much stuff that's still cheap out there. I don't think you need to risk it. And I certainly wouldn't waste a bull market or these kind of, trends and waste it on short-term speculation. If you want to get every dip and rally correct, that's probably one way to, not make a lot of money. If you look at the big success cases, the Great Bears, the Lundin Golds, and all of that, I think absolutely the people that made most out of those cases are and have been insiders who couldn't trade. Because they had to write it up, and there could be months or even years of consolidation, and they just held it. Whereas like vast majority of people will look at those consolidations and say opportunity cost, and basically try to quote fix it, because everybody, that's the best part. Everybody talks about opportunity cost, but nobody actually seems to get it. They consider hindsight investing opportunity cost. It's like down here. Let's pretend this was a long-term chart. It's like, oh, the opportunity cost has been high in silver over this period because it went down. That's totally worthless information. And it's like, no shit. That doesn't matter. Because nobody knows it except in hindsight. But that's how people usually use opportunity cost. At any given point in time, they look backwards, see what has happened, and then say if it was opportunity cost or not. Opportunity cost is at a present moment, given all the available investments, if that's the best place to be for the future. Opportunity cost is not looking back at what has happened that everybody can see and conclude that, oh, it was opportunity cost. I mean, if you can treat it like that, but it's absolutely worthless information. You cannot do anything with that. That's like, I mean, it's basically saying, oh, I shouldn't have been in silver here because it went down. It's like, yeah, everybody can see that. Oh, I should have been in silver here because it went up. Like there's some deep lesson there, or that you can you do anything useful with that information. That's worthless information, unless you have a time machine. Uh, but yeah, I mean, I know this is probably hard to. I mean, it's very hard to do in practice. It's kind of, I like the saying of poker. People say, it's a hard way to make an easy living. Why? I mean, the easy living is that, well, you only play cards and you can do it from wherever, if you're playing online, etc. But it's damn hard to actually do, because like in the stock market, 95%, about 95% of poker players, I think, lose money. Only like 5% are long-term winners. Why? Because it's it's very hard to uh, play well and be better than most people at pretty much all times. Because there's many good poker players that have went on tilt, went up in stakes and lost it, and many are not even better than the average. Obviously, you can say 50% are above average, 50% are below average in terms of skill, but it's not. And then you have to fight the rake, basically. That I mean, if you put 10 people at a table, the side takes some amount of the money in each pot. So at the end of the day, if everybody won equally, an equal amount of hands, there will still be no money left at the end of the day. So you have to beat that enough to actually have more money than you started with, and then you cannot afford to go on tilt. Really, so that's what makes it hard. And investing is like, in a sense, it's somewhat the opposite, I was gonna say, and I've talked about this before, where it's like investing is probably, and I'm talking as an investor, longer term investor, not as a trader, where typically the less you do, the better your returns will be. Whereas you can look at anything else. I mean, am I going to get in better shape by exercising less? Am I going to learn Spanish quicker by practicing less? No. So it's one of the few things where actually most of the time you do yourself a service by not doing anything, which is absolutely crazy and goes against almost everything. And as soon as people have, I mean, any day you have red in the portfolio or the MEL price are red, it's like an alarm bell. You're losing money on paper today, you need to fix it. Because if you're losing money, you're not making money, right? And not only that, since we always basically focus on what the all-time high of the portfolio was, as soon as we're not at a higher all-time high, it's like we're not making money, even though, and probably losing money. If we're talking long consolidations, like, oh, you made a lot of money, let's say you went into a cyclical, short to medium term sentiment peak for the juniors, and they go down down to sideways for 3 to 6 months. On paper you haven't made any money, so it's kind of every other day the portfolio might be red, which sends alarm bells. And vast majority of the time, the portfolio won't be making new all-time highs. You're not making money on paper more than you had at the previous peak, so it feels like it's not working. So basically 99% of the time, almost, or yeah, I mean, it's like 90+% of the time, it probably feels like something needs fixing. Because it's either a red day, or at least the portfolio is not higher than the last high. So basically, your entire investing career is going to be battling quote signals that are telling you to do something, you need to fix something, even though you don't. That is, in my opinion, the hard part. That is like, and just the fact that we can't control everything. You can't control who's buying or selling. So you kind of have to, I like the expression, let Jesus take the wheels. Like, buy cheap, hold it until it's not cheap or you find something cheaper. If it was cheap, you'll end up making money sooner or later. if it wasn't cheap, you lose money. But there's only one way to find out. That's to hold it. And yeah, I mean, just think about this. Let's say it's going to be a 5-year bull market. It's supposed to be in metals and miners. It sure would be nice to find companies that are cheap and have a 5-year pipeline for growth to boot. I mean, that makes sense, right? Let's say you buy something with margin of safety. You think you don't need to be right, but you think, hey, this could be 5-year bull market. If you buy something that's worth twice as much as what you're buying it for, and you think they can increase the value incrementally over 5 years, so you think on average, not again, you might be wrong on something being 50% undervalued, but let's say on average you're kind of right. I mean, some might be 70% undervalued, some might be 30% undervalued, some might not be undervalued, whatever. Let's say you think you're gonna get a double sooner or later in your value cases that you think could go up 100% to fair value. This is just to make an example. And you pick 20 different such stocks, so you think it's somewhat locked in that just by waiting based on what they already have, they should one day be up 100%. And if that takes 2 years, and I know nobody gives a shit about 100% over 2 years, even though 95% of people would kill for being able to compound 100% every 2 years, which is 42% every year. If you if you do that for 10 years, you're going to be up thousands of percent. So it is insanely good compounding, but it's too boring. And funnily enough, that's why I think there are so many cases of that around, because nobody gives a shit about a case that's probably, I mean, put it like this. Let's say you had a junior where it's like, it's almost set in stone. Or for intents and purposes, let's say it is set in stone. God told you that this stock is trading at $1 today. It's going to trade at $2 in 2 years. Most people wouldn't bother with that because there's always a junior that can go up 100% in 1 month. And the worse your previous results have been, the less you feel like you can afford to take only a double over 2 years. That's why they still exist. Because nobody maybe they should be, maybe that should be trading at whatever the, compared to the risk-free rate and all. Let's say it should be trading at $1.7, but it won't, because that's too boring. And it needs to be trading at $1 for it to not be boring enough that somebody actually cares enough. If people would be even less bored, it would be trading at 70 cents and would give 150%, let's say, over 2 years. So the very reason why those cases exist is because nobody cares about those cases. But yeah, back to the point. Imagine if you have, quote, a baked in 100% returner over, let's say, within 2 years. But you think that can grow also 100, 200% in value over 3 years. And you also, as in this example, let's say 5 years. You think a junior is selling for 50% of what they already have, and you think they have enough projects or a project that can grow for the next 5 years. And let's say you pick 20 such companies, and let's say on average you're right, and let's say there's a bull market in over 5 years as well. That gold and silver and nickel and copper, whatever it might be, is going to be trading at higher prices incrementally over 5 years. And sentiment is going to get incrementally better. So I mean, think about that as a case where it's like, okay, you have a baked in 100% returner on the portfolio at fixed sentiment levels, at fixed metal prices. But the company goes up in value in terms of how many ounces they have, let's say. And the metal goes up in value, which is a multiplier to the multiplied amount of ounces. Plus you have the sentiment that goes up, so you get more for the increased ounces
that have increased value. So it's a third multiplier basically, or a second multiplier, I guess. That can amount to certainly multi-baggers, maybe 10 baggers. And again, let's go back to the basis. You pick the companies based on that they're already cheap, not high risk, high reward plays. And you see probable growth. So at face value, if you had 20 such companies, it shouldn't be risky if you have, somewhat good assessment of if they're, cheap to start off with. Because at face value, you have, quote, no risk because you paid 50 cents for a dollar. And you're diversified across 20 names. While all of those names have what you can see probable growth as well. So even if metal prices stay here, even if sentiment stays here, let's say sooner or later you're gonna get 100%. And if you get that within 2 years, great, absolutely great compounding returns. But if you hold them for 5 years and it happens to be a 5-year bull market, for example, you might, in 2 years you might have gotten 200%, and in 5 years you might have 500 to 1,000%. And you started off with being diversified across plays with margin of safety. The risk reward in that is, in my opinion, great. And if you're on average right on the cases that they do increase in value, you might even be able to suffer a decreasing metal prices and still do okay, or even, sometimes even good. It depends on the execution. That's what I call, an all-weather approach. That's why I don't really focus on the short term or try to guess where metal prices are going next or sentiment is going next, etc., or try to predict everything. It's just if you get the micro right, I think that's the best offense and defense you can possibly have. Of course, it's great if you happen to be you pick micro cases where the macro looks good and plays out well. But that's no guarantees, right? The only thing we know at any point in time is the price we're paying for something. That's the only known thing. What the sentiment or metal prices are going to be tomorrow is even unknowable. Price is the only thing. It's also both offense and defense. Cheap, buying cheap. If you buy cheap, the risks tend to be to the upside with time. If you buy expensive, the risks tend to be to the downside with time. Time is the, I guess, name of the game. So let's look. We can actually get back to these here, but let's look at copper. And this is on the theme of, because I have, some copper exposure, nickel exposure, zinc exposure. A lot of the juniors have something or the other. It's mainly gold companies or gold juniors where it's like, there's not many pure silver deposits, but there are pure gold deposits. There are not many pure copper deposits, but again, there's gold deposits. But I don't know what's going to happen first. I believed for quite some time, and I talked about this a few years ago, I think, that my hunch was that we were going to have financial, global economic problems before we had, let's say, the copper's supply shortage really kicked into play. And I know Rick Rule basically said the same, that, longer term he really likes copper. But he thinks there might be, trouble ahead in terms of, this is what happened 2008, for example. It just went straight down. And funnily enough, if you slept through a year or two, you would be back at the same prices. Anyway, I guess the idea being is like, I have a hunch, but I can possibly know what we might have a global financial crisis starting tomorrow. And remember, when the juniors and gold and silver were down, well, let's rewind the tape 1 or 2 years, or let's take 2024 when the juniors were down so much. You've probably seen, and it's like, I don't know how many people told me it's like, well, it's not safe to buy because as a gold bug and a silver bug, you're obviously leaning towards the can not being able to get kicked again by the Fed and all that. I mean, most people who are in gold and gold miners and gold juniors, they're like, oh, the financial system is unsustainable mathematically. The debt of the US just keeps going up, etc., etc. So it's like that can't go on forever. I mean, it's gonna either end in a crash or inflationary crash to the upside, I guess. But a lot of people held off buying juniors because they felt, well, I think the market is gonna crash. And then it's going to bring back juniors. I don't remember the last time I didn't feel like that was a possibility. That's been true, and it's always going to be true. That's also one thing to recognize yourself, and that goes to the leap of faith kind of thing, where that's going to be true forever. There's always some problem out there, and the governments will always, and the central banks will always try to kick the can. We've been, let's say, on an unsustainable trajectory for years and years and years. And to be honest, I'm more leaning towards an inflationary upwards crash than I am to, actually letting this all play out and have a deflationary crash. I mean, how on earth is the US gonna, for example, survive in a deflationary crash with the amount of that they have? I mean, it's basically impossible. So something needs to be done, and it's typical human nature to kick the can. And maybe they simply overprint and we crash up. Weimar type scenario, Argentina, Venezuela, etc. So I don't even know if the crash comes. I don't even know which way it's gonna go, and I don't know when it's gonna happen. So again, if I can't know that, I kind of have to just prepare or plan accordingly, which is that it's unknowable in a sense. So I prefer to have a bit of everything. If we keep kicking the can and everything holds together, we might keep having inflation, and gold and silver could continue to just go up until the real end game. And at the same time, maybe the can is kicked enough that the copper supply shortage starts playing a role. Okay, then you'll make some on, let's say, gold, silver, but you might make more on copper. But if the crash happens tomorrow, let's say everything goes down for a while, but then gold and silver starts ripping, and maybe copper gets killed. So my point is, I'd rather be somewhat right than exactly wrong. If I can just keep a portfolio strategy that's like that for the rest of my investing career, I think I'll do okay. Instead of risking or needing to be exactly right. Rather be somewhat correct for 30 years than needing to be exactly right all the time in a sense. Going back to this, copper looks like, again, I'm not a technical analyst, and I don't, my portfolio doesn't change based on this, but it looks like there's some kind of coiling going on, right? That, it's kind of, there's going to be, copper needs to make a decision because this is kind of narrowing, right? And here looks like it was a kind of I guess false breakout. One could say this was a false breakout, and typically that gets every people on the wrong side, and then it goes down instead. And this was a false breakdown, and then it reverted really quick. But sooner or later, this has to make a longer term decision, I guess. And then you get the traders involved and yada yada yada. This wasn't really, I guess you can say this was some kind of a wedge here. When that broke, copper went on a ripping bull market. And zinc, it's been trading higher since at least, I guess, 2009. Higher highs, higher lows. again, I'm not putting too much emphasis on anything here, except that yes, it's trending higher with whatever the inflation and lower purchasing price of the dollar. And where's 2008-9? Okay, that's not even actually on here, so this doesn't really capture what happened then. But I assume maybe zinc started down here. Anyways, like it looks like commodities are kinda treading higher, and there will be some decisions to be made in copper, for example. Here's a post Glencore's copper supply gap forecast today, and some people have commented the fact that, well, it assumes that all the plant production gets into production the way it's supposed to. But anyway, you can see, and this is obviously some years out, so I guess the takeaway is that at steady state development timelines right now, and discovery rates, etc., and if we just keep consuming copper, and I guess, I mean, there's no financial crisis baked in here or something else happening, it looks like whatever, by 2029 it might peak and then just gets worse and worse. And I guess that goes back to Rick Rude, where it's like, hey, on a 5-year horizon plus, loves copper. In the short term, he thinks that maybe something breaks in the financial system before that, and we might get a something like this before it happens. And during this time, maybe gold and silver does much better. Again, I don't know, so I'd rather have some. It's like when position sizing, for example. It's like try to figure out what the regret levels are going to be beforehand, and and be kind of a devil's advocate, but in hindsight, where in the sense that what if copper starts ripping? It's going to feel better for me to have at least one position that might do okay or well from that than have zero. It's just going to feel a bit nicer, and maybe copper goes up and let's say gold silver junior sells off a bit, then I at least can take that volatility. If something goes up, gold and silver juniors go down, make money on that, lose money on paper in gold and silver juniors, but assuming they are very cheap and the copper juniors not might have gone from cheap to not as cheap, so I take some profit there, invest it down here without predicting it. It just that's what got offered by me by Mr. Market. The opportunities gaps close for, let's say, the copper juniors and open up more for the gold and silver juniors. So at face value, yes, the portfolio is going to go down if I'm overweight gold and silver. Longer term, if I think this is a short-term dip and I can take some profits in the copper, buy some of the gold and silver here, I'm creating more future money without actually affecting the portfolio value today. So I take, let's say, 5% of the portfolio, then went up, bought some of the stuff, 95% of the portfolio that went down. At the end of the day, thanks to this, if these are indeed cheap and they're gonna go here, I'm gonna make more money, because I could use 5% and sell up here, get it down there. So maybe I made 100% on some copper juniors here, added it down here in gold and silver juniors that are going to go up 300%. So the compounding from that small copper bet, for example, is going to have meaningful effect over the long term. And I can also, basically, I was going to say do nothing. You'll make money. It's just that you'll make even more from using the opportunity gaps that widened or narrowed by Mr. Market without trying to predict it. You're just reacting to volatility. And again, it's like, okay, why might we be in a longer term bull market? This is GDX. This was the high in 2011, and it sure didn't feel like we would ever get to these levels during these lows. That felt as probable as, I don't know, the sun not coming up tomorrow. That's what it felt like. Now we're here. And of course, it feels to me, I told a lot of people like this recently, it's like, to me it feels super weird because I'm used to buying depression, because since I started investing in August of 2015 in this space, we've had short bursts of optimism, but then that's usually followed by some kind of crash. And again, going back to when are you actually content? So this top here wasn't overshot until 2024. So 2020. So in a sense, if your portfolio was the GDX, it felt like for 4 years there were alarm bells going off because you weren't making money, more money than you had here for 4 years. Again, going back to why investing is an easy, hard way to make an easy living. And in between that overall 4 year period where you on paper didn't have more money than you had 4 years ago, every other day also pretty much was a red day. So that was just a micro alarm bell that's like you're losing money today, while in the grand scheme of things, it felt like you weren't making any money either, even from medium term, because you hadn't overshot this high here yet. So again, it's like investing is, in a sense, or longer term value investing at least, it's like, in a sense, it's like you need the ability to get pissed in the face 95% of the time, and within that 5% of the time, you're still getting pissed in the face every other day. Because even when things are going up, let's say even in a bull leg, every other day is going to be red. I mean, think about that. That's, in my opinion, I think that's one of the most important thing, and that's why I kept saying that you have to choose, kind of look smart or make money. If you want to make money, you're gonna not look smart vast majority of the time. If you want to look smart, that means you're trying to, you can't suffer looking dumb even for a short period of time. That means you're gonna try to get every single, let's take the daily, every single maybe daily bump or weekly bump. You're gonna try to be correctly positioned for every single one of these micro rallies and micro corrections. That's basically, in my opinion, how you waste a bull market, because it's extremely hard to consistently get every short term up and down correct. That's why I don't even try it. I would say my strategy has become simpler and simpler and simpler. I talked a bit about this a long time. I don't even know what the Fed rate is right now. I don't watch any FOMC meeting. There's now millions and millions of people who watch that, and the market react to that and all this. So why play that game? I only think that if I'm just right that a company is cheap, sooner or later I should have a positive return. I don't know when, and that's also one thing that a lot of people can't cope with, obviously. But I mean, is it ridiculous to say that, hey, this this might have been a super long consolidation phase? So I mean, if we consolidated for 14 years, I mean, I don't know how this is gonna go, but maybe we go like that until whatever the year, And of course, I mean, over that period of time, a lot of things can happen to the dollar, yada yada yada. But that might be what's actually gonna happen. That we have some kind of inflationary upwards crash, and GDX is gonna be at 280. I mean, it sounds maybe ridiculous now, but you never know. I mean, this might be. It's not the start of a bull market. I mean, one could say this was the start of it, I guess. But
point is, I think a lot of us are climbing the wall of worry right now. That's why every GDX actually has gone up with the gold price. Juniors haven't, because they're not directly affected by the price of the metals, so it's easier to ignore them in a sense because you don't get immediately punished. I mean, if I'm selling, let's say, Newmont or whatever miners, like their profits are literally going up and up and up, and I don't care what the gold price is. That doesn't change the fact that they're increasing their cash hoard. The pace of them generating cash is going up. So it's much harder to ignore. Whereas juniors, you can ignore it because it's not directly affecting them either. And juniors are nowhere near at their all-time highs on a EV per ounce basis or anything like that. I don't think. That's why I'm more interested in that, because I think knowing that, yes, if you have a gold junior that's going to be in production in 10 years or might be in production, what does it matter what the gold price is today? No, it doesn't really matter. That's actually right. So in a sense, you can't say that the market is too irrational, because the market can't possibly know what the gold price is going to be in 10 years when they might get into production. But you can still look at the value of the companies, and especially the more advanced one that might be in production in 2-3 years maybe. It's like, okay, what might the gold price be in 2-3 years? Even if gold goes down to $2,100, and that would probably come with some pretty hefty deflation, maybe they're kind of cheap at these prices anyway. So it's like, then I feel like the odds are stacked in my favor. But I guess the point I'm trying to make is, like, I think there might be years left of upward sloping trend with a lot of corrections along the way. And I think it's very much still a time that's like, hey, if you haven't really dabbled into hodling cheap and letting Jesus take the wheel, I think it's certainly not too late. I mean, I know some who have basically, they made some money in the gold space and they're like, well, I'm out. I think this is it. I don't personally think that, and I won't sell until I can't find anything cheap to buy. So it doesn't really matter to me how the chart looks. I wouldn't change. I mean, I'm still full exposed. I'm pretty much all in, even though GDX is here. I was full exposed here as well, and here, and here. I just try to own stuff that I think has risk to the upside with time. This doesn't affect, again, it's like, if this was a false breakup, or if we were, instead of up here we were down here, I would be owning my cheap stuff anyway, because that's not GDX. And again, we talked about this, I think, last video. Silver, again, if you have a, and I think there's other charts where it's like more like inflation adjusted, and it's, I guess, more of a flat kind of cup and handle situation. But again, just looking at a chart like this, if the rule of thumb is the bigger the base, the higher in space, and we're just making a breakout in silver right now, where is silver gonna be in 5 years? I have no idea. I think the risks are to the upside though. And again, going back to, if you buy some cheap silver juniors that you think are cheap right now and could increase their value, if you're right on that and silver goes higher indeed while they're creating value, and sentiment is going up along at the same time, then you're gonna make
money, then you get a multiplier on that, and then a third multiplier, which probably means you're going to make a lot of money. If silver stays flat, but they create value, you should be making some money. If silver goes down, but they create value, you might make money, or might not lose much money at least, unless silver and sentiment goes down a lot. But sooner or later it's gonna go up again. And if the more money, I mean, put it like this, let's say you have 50 million ounces of silver in a junior. You think they could get to 150 million ounces, and they do that in 3 years. Even accounting for dilution, if that's a quality project, it just got better, and then you have the multiplier effect from 150 million ounces being worth more per ounce basis than 50 million ounces, because 50 million ounces might be under the threshold for actually that deposit being mining worthy. So all of a sudden you have 50 million ounces that are probably not going to be a mine, or probably going to be a mine, but maybe not, to 150 million ounces, and that makes it, let's say, definitely going to be a mine. So all of a sudden each one of those 150 million ounces are the probability of them actually turning into cash one day might go up, go from I don't know, 20% to 80% or something. A huge value add, obviously. And if silver prices are higher when they go into production, you'll make even more on them. And if sentiment is better, you'll get rewarded more for the production, etc., etc. So it all comes back to stacking the odds in my favor, that I don't preferably need to be exactly right. But if I did it, I went all in on marginal plays for silver, that no good projects or only exploration stories starting with off with no silver, I might risk ending up with no silver regardless of where silver goes. Or if I have just marginal producers, marginal deposits, and silver goes down, the producers will go bankrupt and the marginal projects will dilute, but be even farther away from actually turning into mines. So then I'm risking being exactly wrong in a sense. That's what I'm trying to avoid. Newmont, I mean, kind of like, I guess, GDX. Funny thing, though, is that this goes back all the way to 1987, and I remember this. I actually thought at the time this was a real breakout, and that, the age of mining, the age of the gold miners had started. What happened, it turned out to be a false breakout. Instead, it reverted, and Newmont went down 65 goddamn percent, and that's a major, the largest major from a production standpoint. Went down 65 goddamn percent, like it's a junior. And then sentiment got bearish, and I remember there were analyst reports that came out with, I think, sell targets or sell recommendations down here. Classic. Then it went up again, and what was my point gonna be? So now we're, let's say, getting rewarded. What did this allow? I mean, instead of going like that, which would be a smoother ride for any Newmont holder, people got a chance to pick up Newmont at cheap prices, and this is how the future returns until today, how they change with the. So I mean, down here, that's 200% in a major in 1.5 years, 200 goddamn percent, and this was like 147% in let's say 10-11 months. That's absurd compounding, which then goes back to the idea that a bull or a bear market is not good or bad per se. It depends on what you do in them. You can and I've done this example before. Let's say you have 3 people here that buy the top, and then it's a false breakout, and this happens. You have one person who sells out. Let's say he goes with the analyst recommendations. So he sells out. He cements a 65% loss from his investing journey. That's not a long period of time. So he converts a paper loss to a permanent loss, let's say, in 2 years. Cut his portfolio by 2/3 in a year. You have a person that holds it, who has a paper loss of 65, does nothing, and you have a person who buys more, whatever, 10% regardless. Then prices go up again. Here, let's say Newmont was indeed too cheap, and this applies to any, obviously, company. So the guy who bought high, sold low, he walks away with minus 65%. Probably bought a high in another sector and compounds the mistake. The holder at least is flat to somewhat green, so he didn't end up losing money over 2-3 years, but he didn't make any, and was outperformed. You're gonna hear everyone say opportunity cost, sure, but he didn't lose money. The one who buys, depending on how much he bought, and he could be averaging down this entire time, he'll actually end up making money. So you have the same market action. 3 different investors, 3 different choices, decisions, and they have completely different returns. He who sold low, he got victimized by the correction. He let the correction cost in 65%. The one who just held, he made some money, and the one who bought, depending on how much he bought, actually made money. Same action, 3 different investors, 3 different decisions, 3 different outcomes. Which is just a point to make that it's indeed up to us. It's up to our quality of decisions, or ability to, let's say, be contrarian. I don't like to call it contrarian because I don't think there's much contrarianism in buying something that's cheap. Contrarianism was more like, bottom 2015, when no gold mine was making any money really, and no silver mine was making any money, and you were buying stuff that was worth at the face value, betting that, hey, prices are going to go up and they're going to be worth something one day. That, I would say, was more contrarianism, because it at least included the fact that something needs to change for the prices of the metals, and then this will look really cheap. Whereas like now, with gold prices as high as they are, and even silver prices as high as they are, there's stuff out there that's cheap right now. They're not pricing in current gold or silver price, might be pricing in much, much lower gold and silver prices. Then they're de facto cheap. So then something has to change to the downside, maybe a lot, for them not to look cheap. That's not really contrarianism. That's just, that's some speculative margin of safety. And yeah, so here we go to BHP, world's largest mining company. It's a diversified miner, a lot of iron ore, a lot of copper, I think. They've been closing down some nickel. But this also looks like some kind of wedge. That sooner or later, these trends are converging. So BHP, by default, has to break out in one way or the other. It's not exactly the same, but I mean, I think this looks somewhat similar to this. And what happened then? Well, it did end up breaking. It broke to the upside, and then it basically ran for 5 years, went up 731%. And that is the world's largest mining company. It went up 731% over 5 years. feels kind of crazy. I mean, imagine if, and this is an even longer consolidation. That's why what I mean is like I don't maybe that's going to signal that the copper supply crunch is here, or some AI yada yada, or maybe it's going to break down. Maybe we're going to have a financial crisis and it breaks down. I don't know, but it doesn't change the fact that there's not much new copper supply coming on. Or maybe something else changes. Maybe the demand for copper goes up. So if I had to guess, I think the next big move for BHP is up, not down. But if that's the case and we break out in 6 months from here, maybe that's going to start a 5-year bull market in BHP. And what would kick that off, I guess, or what would be behind that? Maybe a 5-year bull market in commodities broadly. Maybe copper, since that's also, as we looked at earlier, coiling in some way. Maybe it's like, because it's been grinding kind of the same, almost as, maybe not exact the same highs maybe, but since 2021 it's kind of been almost doing what gold did when it was grinding the 2000 level. It's just that this is slightly, sloping upwards. And yeah, Newmont we looked at. Rio Tinto is kind of in a similar situation, I guess. I mean, again, don't read too much into this. You can, I guess, make a shorter term consolidation here, and that's when it's already broken out of, I guess. But yeah, I mean, if BHP is coiling and is the world's largest miner, and Rio Tinto is also a diversified miner, which is the second largest, I think it kind of goes without saying that probably one is not going to go like that and the other one is going to go like that. So I think if one is probably coiling, and this looks like it's coiling, it's probably coiling as well. And it wasn't the exact same shape, but this is what Rio Tinto did before, up 581% over 5 years after this thing here, broke out. And I guess, again, depending on how you want to draw the lines, maybe you do it like more like this, that this was a fake out and this it retested, whatever. I mean, I guess that goes back to the details versus the noise signal versus the noise. Regardless how you exactly draw the trend lines here, I would surmise that both of these are going to start some longer term trends sooner or later, and it looks like the decision time is kind of running out. So it's going to happen in, I don't know, let's say within the next 12 months. And if that happens, again, just, if it's the rule of thumb, we go after, higher, bigger the base, higher in space. I mean, this is a long-ass consolidation for Rio Tinto. So I'm just going to say exciting times. And I have no idea what's going to do best over the next 5 years. Is copper going to do best? Is silver going to do best? Is gold going to do best? Is nickel going to do best? Is zinc going to do best? I just think that in a time of crypto, AI, polymarket, OnlyFans, all of that, fake stuff, everything becoming more artificial, everything getting more short-sighted, everything going, I mean, take MicroStrategy, where it's basically as far as I see, Bitcoin being a, greater food trading sardine, and maybe some get pissed off by that, but it's like, if there's more buyers than seller, it's gonna, go up, and that's the, beauty which everybody points out. There's like, the whatever supply, and of course that's what MicroStrategy is trying to kind of do, corner it. That's like the more they buy, the easier it is to for Bitcoin to go higher, which allows them to buy even more. So it's kind of a momentum play on a momentum play. And as long as if that's going up, I mean, yeah, that's it's like not, it's like almost like leverage on leverage in a sense, I guess. But in a time like that, when that's kind of prevalent, it's like I I'm more and more and more happy about sticking to the basics because as we know, commodities underpins every web camera that OnlyFans uses, every server that's used for AI, every mining rig that's mining Bitcoin, every S&P 500 company, every Nasdaq company, every single thing, every single company on S&P 500, Russell, Nasdaq, everything is underpinned by commodities. So that's why I like the meme. I use it mostly for gold, where you have I don't know, maybe an Indian sitting on some, a high spot and watching out, and there's a bit of chaos in the background. Where it's like, I don't need to bet. This goes back to the rather be somewhat right than exactly wrong. I don't need to know what technology is gonna work. I don't need to know if Grok is gonna be the one that's the if it's a winner take all situation for AI, that um, one type of technology or one company works, or what crypto works, or what OnlyFans work, or anything like that. Because regardless who the winner is, they will need commodities. And who knows? Maybe it's gonna, AI is increasing the demand for copper, for example, and maybe AI comes out with some, that, like Elon Musk, I think, there's going to be, a bunch of robots in the future. It's going to eliminate poverty, and everybody's going to have a universal basic income. It's like, okay, it might happen, but still, I mean, you're not going to have a single robot without copper. You're not going to have a single robot without silica or gold or silver, maybe, or nickel, and etc. So again, it's like the lowest common denominator are commodities. So it's like, I don't want to play let's say the IT bubble in 2000s, where yes, some companies that got spawned there, let's say Microsoft and all that, they became absolute giants. I mean, the few who survived the crash, some of them went on to do really big things and change a lot of stuff for humanity, modern civilization. But vast majority of them died. That's why Buffett says, he puts it in the too hard pile. That he wants to be able to look out in the future and have a reasonable idea of what the future is going to look like for that company. I have no idea what crypto might survive. I have no idea what AI might win. I have no idea what type of robot might win. Just go to the movie genre. It's like, oh, there was VHS, and then it was like Blu-ray, and they competed with, I don't even remember what the other, something disc, I think. Whereas like we went from cassettes to CDs to whatever it was, iPods, and now we have it in the phone. Whatever. They all use technology or commodities. So that's what I like. It's like I want to make it as easy as I can for myself. Are we gonna use commodities in the future? Probably. If we're not gonna use commodities in the future, it doesn't really matter then what the portfolio does. If there's a World War III and we all get blown to pieces, or there's a solar flare, or there's a whatever, then it doesn't matter either. But if there's gonna be a civilization, if there's a civilization in 10 years, modern civilization, we're probably gonna require metals. if we don't require metals, we probably don't have a civilization, and then it doesn't matter. It doesn't matter if you bought Apple or BHP. We're gonna be, throwing spears and shooting arrows at each other, maybe. So it's like those outcomes are, not really needed to think about, I would say, because again, doesn't matter. It's the same in a sense with a global financial crisis. Like, is that gonna come? Yeah, it's most likely gonna come. It's like, is the debt bubbles unsustainable? Yes, they are. Unless something weird happens again, like, oh, AI and robots fix everything and yada yada. But still, there's if you had all the copper in the world and everything was done by robots in the future, if you would own all the copper, maybe you control the world. Because there's not going to be any robots without copper. So you kind of, still win in that messed up, or weird future. I hope that makes sense. That's why I'm. The longer I've been investing, the more chill I've become. It's like the only obvious. Well, the obvious. Well, the big returns are in the big moves, the longer term moves. And I think we're in a bigger, longer term move. I mean, historically, metals, they trade higher because dollar, whatever currency it is, it gets debased, right? So that's not a you're not prophetic for stating the obvious, but point is that I think these signal that we might, gold miners, it appears they have broken out of massive patterns. Silver looks like it's breaking out from a massive pattern. Copper looks like it's gonna break out of a massive pattern. BHP and Rio Tinto, which are massive mining companies, looks like they're gonna break out of massive patterns. And if I had to guess, I think these are gonna break to the upside, and I think silver has already broken to the upside. I think looks like Newmont has already broken to the upside, and looks like GDX has already broken to the upside. So given the scale of these breakouts and potential breakouts, they're probably gonna create long-term trends. I'm talking multi-year trends when they actually break out in the direction they broke out. So settle down, strap yourself in. We might have several years worth of bull market action, and the best way to waste a bull market is to micro trade. And again, just looking at the 8-year bull market in Huey, look at how many consolidations, plenty of long corrections, monthly corrections. 95% of the time, if your portfolio was the Huey, 95+% of the time it was not making new all-time highs. So again, let's say then account for the fact that when it was making new all-time highs, it was probably going down every other day. So 5% of the time you actually saw higher overall action than the previous high. But during that 5% of the time, you still get pissed in the face every other day. So again, strap yourself in for, let's say we're going to have a 5-year bull market ahead. Strap yourself in to get pissed in the face for 5 years and still make money by doing almost nothing except sitting in cheap stuff. That's what I think we can have in store. And in the meantime, we're gonna be, in that case, be climbing the wall of worry. We're climbing the wall of worry right now. We're climbing the wall of worry even though this is happening in silver, for example, and Newmont. I'm talking about the junior specifically. Yeah, so it's like it's not sexy, but hey, what is sexy is if you have 6 screens at your house and day trading. I mean, take any. I mean, what do people like? Uh, what do people think of? Let's say everybody wants to be a stock market shark basically, and that's like when you see pictures. Let's say you Google trading yada yada. It's like, oh, some guy sitting there with 6 screens and there's data all over the place, like it's super sophisticated. It's like it's sitting in a spaceship command center or command room, and it's like, whoa, I'm so sophisticated because I have all these 140 different whatever it might be indicators, and I'm like, oh, I'm trying to guess what the Fed is gonna do, and blah, blah, blah. Yeah, that's what attracts people. You can't put in a textbook. It's like, or hey, buy cheap and then wait. The good old, Warren Buffett, Charlie Munger approach, where it's like, hey, we think the value of this is higher, and then we might hold the company for 30 years. And on average, I mean, look at Berkshire Hathaway. Same thing there. Uh, Berkshire Hathaway went up, or let's actually let's look at good old Berkshire. Oh, oops. So obviously, Warren Buffett is I don't know how much money he has, or he's worth what 200 billion. And you look at his chart and it's like, well, this looks like an easy hodl. It's just going up, up, up. Yeah, that's a long-term short. And then look at the actual consolidations. So here. I mean, I'm not gonna do all of them, but like here, here, here. I mean, broadly speaking, here, and then in between. I mean, and these are not. I mean, they look small at this timeline, but this is February of 2017. So this is 5 months. Let's say almost half a year there of no new all-time highs. Then it went up a bit, new consolidation, yada yada. But if you added together the time spent where Berkshire, aka Warren Buffett, was not worth more than he was at the previous high, it's probably gonna average out to around 90-95% of the time. I would say. Whereas like here you have, and then you have a pretty big correction there, and then this, let's say that lasted all the way to marginally higher here, but not meaningfully. 2022. So that's 2 years again, and then it rips for a while, consolidates. So yeah, let's say 90-95% of the time, Warren Buffett was looking at paint drying basically. When you zoom out from watching paint dry, it's up 1,639% in 25 years. And if you look at the compounding, that's probably not going to be superb. I mean, way less than you think. This is almost 28 years compounding. I don't have the CAGR calculation right now, but I don't know what that's going to amount to. Maybe 15% per year, whatever. So it's, and I mean, it's so slow. It looks so slow. But the end result is breathtaking, obviously. That's the power of compounding. And he started before that. I mean, down here, I guess here's 2,400. Here it's 800. What was, I mean, look at this high here, for example. 800 down to 1,000. Huge difference. But you get the average if you're hodling, obviously. So yeah, point is like, I mean, you should do what you feel like, obviously. I mean, what suits you. But I just want to stress that I think there's a decent chance that we might be in for a multi-year bull market. And the only way to really capture that is to hold through the bull market. If the bull market lasts for whatever, 8 years here, or I mean, this was actually 11 years, but let's say 7 years from here to here, you probably made the most from just holding it for 7 years, for example. If you traded in between, you probably did not beat a hodler. Almost certainly not. Like, I am pretty sure that, for example, the insiders in, whatever, Snowline and Great Bear and Lundin Gold, I mean, they're the ones that captured the full move. They probably made more than every other trader that went in for a while, and sometimes they made 30%, sometimes they lost money. So it's like they might have done, let's say, 40 trades on the way up to a 20 bagger, and they walk away with maybe making 200% on Great Bear. I'm just making a number up, whereas like the hodler made 2,000%. So I mean, to me, and then when we're talking like quality of life, do you really want to sit and be a day trader and catch every single move, or actually just, hey, these are cheap, they should be higher within 2 to 5 years? Evaluating all that, not looking for new opportunities, but it's like, hey, I'm gonna try to catch this big move and not be exactly risking be exactly wrong. Yeah, I hope somebody got something out of this. I personally, I think, or I should put it like this. The best part is that if you start off buying cheap, the risks are to the upside anyway. And if this indeed turns into a 5-year long bull market or something, you can just imagine what a cheap company bought or held today and held until 5 years from now, what that could be worth. If we, in fact, you are right on average on them being cheap, you are right on average that they will create more value over 5 years, and you are indeed correct that metal prices or end up being correct or looking correct, that metal prices does indeed go up and sentiment goes up, so you have the multiplier on multiplier, and you start off buying cheap. And worst case scenario, we don't have a 5-year bull market, but at least you bought cheap, and you're probably gonna make money anyway sooner or later. And worst case scenario is that modern civilization goes away and everybody loses in a sense, but then it doesn't matter, right? So thanks for listening. If you want, I'm happy to talk about, let's say, topics that somebody has some, or finds difficult or whatever. It's no point in me making videos if nobody finds it interesting what I talk about, or doesn't need any, let's say, maybe some help in some department. If anything, I think this at least goes to the, copium, for example, during the correction or the bear market. I think the merit of that is simply getting people not to have sold out at the 2024 lows, for example, and actually were buying. Obviously, that's paying off in spades today or since then. But I also think, obviously, if we are indeed in for a bull market. I mean, one thing is not selling low and buying low. The other one is obviously holding a long time in the bull market. I mean, again, going back to 3 different decisions. Let's say you bought here or whatever. Not selling here and buying here is obviously great. But if you sold here, then it doesn't really matter. So I mean, obviously the best thing for somebody who's bought here was to buy. I mean, if not the bottom all the way down, and then hold for 8 to 11 years, and you would make shit ton of money over that time. But if you indeed bought the bottom or average down, but you sold or couldn't hold or you whatever sold here when you were back to even, I mean, you still missed out on a lot of returns. Obviously, you might have, let's say, yeah, I mean, if you got out at even, you made no money. You got back to square one instead of, making a lot of money. Anyway, thanks for listening. Not investing advice. Don't buy and sell. Not buy and sell recommendation. If I talk about any companies, assume I'm biased. Don't risk money you cannot afford to lose. Again, most people should probably not have as much exposure as I do, etc. I can just speak from how I'm thinking, what fits my psychology, what fits my, let's say, lifestyle and all that. Thanks for listening. Bye.